Hello, everyone, and welcome back to Money and Banking. We're moving into Chapter 6. We're going to be talking about the risk and term structure of interest rates. In this chapter, we examine the sources and causes of fluctuations in interest rates relative to one another, and we look at a number of theories that explain these fluctuations. What we're going to be doing is, we're going to identify and explain at least three factors that explain the risk structure of interest rates. We're going to list and explain three theories of why interest rates vary across maturities. Let's take a collection of bonds with the exact same maturity, 5-year, 10-year, whatever you like it to be. These bonds with the same maturity may have different interest rates. So there's something other than maturity that's driving interest rate differences across assets. What are these three elements? Well, one of them is default risk, which of course is the risk that the entity refuses to pay on the loan. The second is liquidity, and we've used this term a lot in this class. This is the ease at which an asset can be converted into the medium of exchange, or cash, if you will. And lastly, something we haven't talked about, but what we will talk about, is tax considerations. Tax considerations play a role, of course, because your rate of return will be different depending upon how the asset is taxed. Let's take a look at our graph, Figure 1, long-term bond yields, 1919 to 2017. You're looking at this graph, the annual yield is on the y-axis, and a couple things jump out at you. One of the most obvious things that jumps out at you is that all of these interest rates are related, right? They all seem to hinge and depend upon each other. If one of them is going up, it pushes the rest of them up. If one of them is going down, they're all going down. So these yields, these interest rates tend to co-vary, if you will, right? Another thing that you notice is that the hierarchy of colors in this diagram stays relatively consistent over the period of time that we're looking at. So not only do we see co-movement, but we see that this hierarchy seems to be sort of, fixed, if you will. Let's take a look at that hierarchy and see if we can explain why we have it, right? So let's take a look at the top line. This is the blue line. This is a corporate BAA bond. The next line in the hierarchy is the red line. This is the corporate AAA bond. Continuing down the hierarchy, we see the dark green line, which is U.S. government long-term bonds. And then, of course, at the very sort of bottom of the hierarchy of interest rates, we see state and local government bonds, or munis, or municipal bonds. So let's take a look at this, right? We know that the U.S. government long-term bond rate is the risk-free rate because, of course, the U.S. can always either raise taxes or print money in order to pay its debts. So there is no risk that it might have to default. It might choose to default underneath some strange political circumstances, but it would never have to default. Right? So that's your safest bet. Now, corporations can't print their own money, and they can't forcibly, by decree of law, raise revenue like governments can. They can say, well, the law is you pay more in taxes, you pay more in taxes. But Amazon can't say the law is that you buy more goods from Amazon. It doesn't work that way, right? Because exchange is, of course, not compulsory. Yeah? So corporations have a higher risk than long-term government bonds. One of the risks associated with it is, of course, default risk. They could potentially default. Now, among our two categories of corporate bonds, we have two different designations, AAA bonds, the red line, and BAA bonds, the blue line. As we'll learn in this lecture, we can rank corporations according to their riskiness, or according to their likelihood of missing a payment, their likelihood of default. And as we grade these companies, what we see is that corporate AAA bonds are very, very safe. They have a very, very low default risk. And corporate BAA bonds are somewhat more risky. They have a higher risk of default. So One of the things that we're seeing in this hierarchy between U.S. government bonds, corporate safe bonds, and corporate less safe bonds is, of course, risk. Yeah, these entities differ according to risk. We've kept maturity fixed on all of these bonds. It's all the same maturity, but the difference between the U.S., the BAA, and the AAA bonds is, of course, risk. As risk increases from the U.S. government bond to the AAA bond to the BAA bond, as risk increases, we see an increase in the interest rate required to hold those bonds. Okay, that should make sense. We see a clear delineation of this. And as the U.S. interest rate increases and decreases, this pushes up the rate of return needed on other bonds of higher risk. So you can think of the U.S. long-term government bond rate setting the benchmark, and then there's a risk spread, an additional amount of compensation that is required for bondholders to purchase riskier assets, and that risk spread increases and decreases off of that basis sort of root pricer of risk, which is, of course, the risk-free rate. Well, state and local governments, they don't print dollars, right? They don't have their own treasuries where they can print dollars, their own Federal Reserves. And so they don't have as much of a guarantee that they would be able to pay their debts as the U.S. government does, because, of course, they don't print money. They do, however, generate taxes, and so they do have a compulsory way of generating revenue through the form of tax revenue. Well, if they are slightly more risky than U.S. government bonds, why is it the case that the interest rate is lower on munis than on government bonds? I mean, our theory so far is that as risk increases on bonds of similar maturity, so too does the interest rate that is required to pay out in order to induce bondholders to take on that risk. Well, the answer is that we haven't really negated our risk factor. What we need to do is incorporate another factor, and that factor is, of course, tax treatment. As it turns out, state and local government bonds, or muni bonds, municipal bonds, are tax-free, right? And so when we're looking at that interest rate, supposing that they paid the same interest rate as U.S. government bonds, well, you have an interest rate of whatever, 3% from a U.S. government bond and 3% from a muni. Which one do you hold? Well, the muni is tax-free. So, as you walk away from it, you'll get that full 2-3%. But the U.S. government bond, well, that'll have an income tax associated with it when you sell it or when the capital gains come in, and that will eat into the stated interest rate. So you would, of course, then prefer munis to U.S. government bonds because your after-tax rate of return would be higher since they're free of taxes. As a consequence, the interest rate is lowered on munis because you need a lower rate of return given the tax escape that you have in order to entice individuals to hold the bonds. And we'll do some models of this, but essentially what you're seeing here is risk as well as tax treatment playing out in explaining the difference of interest rates on bonds of similar maturities. Risk in the structure of interest rates. And default risk, we've talked about this. I think you know what it is, right? The probability that the issuer of the bond is unable or unwilling to make interest payments or pay off the face value of the bond. U.S. Treasury bonds are considered default-free because, of course, the government can raise taxes. The risk premium, which is a term we want you to be very comfortable with, is the spread between interest rates on bonds with default risk and interest rates on the same maturity Treasury bonds that have no default risk. So if a Treasury is paying 3% and a AAA corporate bond is paying 5%, the risk premium is, of course, 2%. 2% additional compensation that bondholders require in order to hold the additional risk associated with corporate bonds, right? So this risk premium helps to incorporate or price risk, and the market ends up determining what that price of risk will be. How much of an increase in the risk premium needs to take place in order to induce people to buy the bond, right? Once they buy the bond, that risk premium is given, and we know the price associated with a specific amount of risk. Go ahead and look at a simple example of this. Let's orient ourselves first, right? Figure 2, response to an increase in default risk on corporate bonds. Looks like we've got two markets here. So let's look at our two markets, head down to the x-axis, and these are labeled nicely for us, right? In our panel on the left, panel A, we're looking at the corporate bond market that has, of course, some default risk. In the market on the right, panel B, we're looking at U.S. Treasuries, right? The bond market for U.S. Treasuries, a default-free security, right? Let's start at an initial equilibrium. Suppose that markets had settled on an allocation of capital between these two markets, and that allocation of capital was indicated by the equilibriums in a blue line. So that'll be our starting point, is the blue corporate bond supply and the blue corporate bond demand on the left-hand side, and on the right-hand side, we've got the blue supply of treasuries and the blue demand for treasuries. And we've got an associated equilibrium price. In the corporate bond market, that price is PC sub 1. And in the U.S. Treasury bond market, that initial equilibrium price is PT sub 1. Now, something happens, right? There is a shift or a shock. And the one we're going to be analyzing here is step 1, right? The little box up on the high left-hand side, an increase in the default risk on corporate bonds, right? So as the corporations were viewed to maybe have shaky boards of directors or shaky accounting or maybe some negative balance sheet effect or something else, individuals look at the corporate bond market and view them as being more likely than they were before to default. As you can imagine, this additional risk associated with the corporate bond will reduce the appetite to hold corporate bonds. This increase in default risk will shift the demand curve for corporate bonds to the left. This, of course, will open up a disequilibrium in the corporate bond market. Price of corporate bonds is too high in order to induce people to buy these bonds, considering that they're more risky. And so this excess supply of bonds in the bond market starts an auctioning process, and the price of bonds begins to fall. And eventually, we'll reach a new equilibrium at the red PC sub 2, and our corporate bond market now is in equilibrium. Well, where is all of that bond demand going, right? It's leaving the corporate bond market, and it's probably seeking something that is more of a safe haven, since it's avoiding the risk that is now more enhanced in the corporate bond market. So as that corporate demand curve shifts in and the demand for corporate bonds shifts in, individuals still need saving instruments, and obviously they prefer them that have less risk than corporate bond market, or they wouldn't be leaving. So where do they go? They go into the treasury market. And so the secondary effect is, of course, that the demand that's escaping the corporate bond market goes into the treasury market, and the demand curve for treasuries shifts out to the right. This shift is the blue line, DT sub 1, shifting to the red line, DT sub 2. This, of course, opens up excess demand in the treasury market, driving up treasury prices until we reach our new equilibrium at PT sub 2. Right? Now, as we've learned in the past, as you are very familiar with, well, bond prices and interest rates are negatively related. So as the bond price of the corporate bonds is declining, the interest rate on corporate bonds is rising, right? These things are risky, they're less attractive. We need to pay out more interest to entice people to hold them, right? And in the treasury market, as we're pushing up the price of treasuries, we're pushing down the interest rate. And so the spread here, or the risk premium, would be the difference between the interest rate paid on treasuries, the risk-free, and the interest rate paid on corporate bonds, right? That risk premium or gap would be the difference between IC sub 2 and IT sub 2, basically just the difference between the interest rate paid on corporate bonds versus treasury bonds. Now, whatever that risk premium is reflects the amount of risk appetite in the market, right? At some point, interest rates rose above treasuries sufficiently enough for individuals to buy those riskier bonds. And so that action of buying the bonds prices the risk of securities. So markets are a good way that we determine what the value of risk is, what the price of risk is. And we measure that, of course, with our risk premium. Now, once this risk premium has been established, right, We always need to have that gap in order to keep the markets in equilibrium. So, supposing that it is a 3% risk premium, right? You need to be paid 3% more than treasuries in order to get you to buy these corporate bonds. Well, if the treasury rate is 2%, then the rate on corporate bonds will be 5%, right? And if the rate on treasuries is 3%, then the rate on corporate bonds will be 6%, right? And if the rate on treasuries is 5%, well, then the rate on corporate bonds is going to be 8%, right? So what you can see is as the U.S. Treasury interest rate moves around, it pushes the interest rate on all other assets, since those assets are measured, the interest rate on those assets is measured relative to the risk-free rate according to how much risk needs to be priced into the bond, right? So we've got co-movement of these interest rates, and we've also got that hierarchy of interest rate spreads that we saw in our diagram, all explained nicely by differences in risk on bonds of similar maturity. Let's take a brief moment just to look at the way some of the rating agencies define their riskiness, right? We've got a couple different rating agencies. We've got Moody's, we've got S&P, we've got Fitch, right? And they all have some kind of grading system that they've used here to communicate the riskiness of the bonds. Triple A, as you would see from Fitch or S&P, these are prime maximum safety bonds. These are as close as you can get to risk-free bonds. And as you can see, as default risk increases, the grades, and you're all familiar with grades, sadly enough, right? The grades start to come down, right? From AAA to AA plus to AA to AA minus, and so on and so on and so forth. Well, this half of the table that we're dealing with, we can move all the way down to triple C rated, and then of course D rated, which means, hey, this thing is in default, if you will. Right? So ratings agencies are third-party institutions that provide information about the riskiness of corporations. This makes sense. That information will be very costly for every individual to acquire on their own, right? You're thinking about buying a corporate bond and you do all of the research to figure out how risky these things are, right? That's a tremendous cost to you in terms of entering the market. You're not even sure if you'll be getting accurate information, right, from the corporation itself, right? If the corporation is selling bonds, it has every desire to try to convince the customer, of course, that the bond is risk-free. There's no risk at all. And it has, of course, the incentive to do so because it means it will pay lower interest rates on its borrowing if you can convince the consumer that, of course, they are risk-free rather than, highly speculative, if you will. And so it's very difficult to have private markets where, information is provided either by the buyer or by the seller. It's very difficult for those markets to produce information efficiently. Yeah? And it's called the lemons problem in economics, right? If you're buying a car, you want to convince the seller of the car that it's a piece of garbage so you can get it for a deal, and the seller wants to convince you that it's an absolute cherry of a car so they can get the top dollar from it. And so, you need to eventually find a mechanic that's going to have a dispassionate, third-party, disinterested view of the value of the car. And that's what we were trying to build, when Moody's and S&P and Fitch, struck up their business model of being a information provisioner. As it turns out, many of them failed at this task during the global mortgage-backed security. Starting in 2007, the collapse of the subprime mortgage market led to large losses among financial institutions like Lehman and Bear Stearns and the like, right? As a consequence, many investors begin to doubt the financial health of corporations with low credit ratings, such as BAA, and even began to doubt the ratings themselves. This was, of course, because investment banks were paying S&P and Fitch to grade mortgage-backed securities. Mortgage-backed securities had not existed for a long time. We didn't have a lot of market data on them, and so Fitch and Moody's and the like were paid by investment banks to rate these securities. This is like the seller of a car paying the mechanic to do a diagnostic in front of the purchaser. Of course, the risk is that the mechanic inflates the value of the car, it inflates the quality of the car in order to keep the seller coming back to pay for provision of information. And so mortgage-backed securities were rated as AAA, which we all know now was a gross understatement of the risk involved with them. Now, there are other reasons why the entire system, including the rating agencies, grossly underestimated the real risk associated with mortgage-backed securities, but we'll get into that later when we discuss financial crises. Risk and interest rates. Well, one of the things that, of course, governs how valuable this thing is to you is liquidity, which is the relative ease at which an asset can be converted into cash. Liquidity has to do with, are there transactions costs of selling the bond? As we convert it into cash, is there some friction or barrier that will prevent us from doing so or increase the cost of us doing so? So the higher the cost of selling the bond, the lower the liquidity is assumed to be. Right? Another important element of liquidity is how big is the market? How deep is the market? How liquid is the market? This depends on the number of buyers and sellers in the market, if you will, right? So if you're thinking about something like iPhones and you're trying to sell one used, it's a very deep and liquid market with many buyers and many sellers. If you're thinking about rare, fine wine that is extremely high priced and only a few collectors would be both knowledgeable enough and wealthy enough to be interested in it, well, you're dealing with a much less liquid market. You may only have 500 institutions or entities in the world that would be interested in a $5 million Picasso, but you have hundreds of thousands of people that might be interested in buying your 2-year-old Audi in the New York area, right? So the number of buyers and sellers important for liquidity. The more liquid an asset is, the more valuable it is, right? And thus the lower interest rate that it will have to pay in order to entice people to hold that asset. The less liquid, the more the downside is for the holder of the bond, the purchaser of the bond, and the higher the interest rate will have to be to compensate them for that lost liquidity. We saw that liquidity played out in terms of looking at interest rates on bonds of differing maturities. So, short-term holding of bond, more liquid, lower interest rate, longer-term bonds, less liquid, higher interest rate. This was because of liquidity and also because of interest rate risk, which we discussed in previous chapters. Last but not least, our third component that helps us to understand interest rate differences or spreads between assets of similar maturity is, of course, income tax considerations. Yeah, if you went to work and paid no income tax, well, your take-home pay would be higher, right? And if you go to work and, of course, you pay taxes, well, that's money you never see. It's money that never goes into your pocket. Your take-home pay is lower the higher the tax considerations. And so we'd need to entice people with higher interest rates to compensate them for higher tax rates. And if we don't have taxes on an asset, of course, we don't have to do that, and the take-home interest rate can be lower because the take-home interest rate isn't eaten into by tax considerations. Let's go ahead and look at a model of how we might sort of, visualize what's happening with these tax considerations, if you will. Again, we've got two markets. There's going to be migration of buyers between the two markets based off of, risk profiles and tax considerations and the like. Let's run an analysis. So what we have on the left-hand panel, panel A, is a market for the municipal bonds. These bonds are tax-free. And then on the right-hand side, of course, we have the market for treasury bonds, both government entities. The primary difference between these two is the tax consideration. As always, we start with our blue supply and demand lines in each panel to sort of anchor us as to where our initial equilibrium was and where those blue lines intersect in each separate market. Well, that is our equilibrium. In the municipal bond market, it occurs at PM sub 1, and in the treasury market, it occurs at PT sub 1. Then something happens, right? Let's say that all of a sudden the government decrees that there is a tax-free status on municipal bonds. So they were paying taxes before. You did pay taxes on them before. Now, all of a sudden, we've changed that. You don't have to pay taxes on them anymore. Well, now, relatively speaking, right, the take-home interest rate will be higher than that on treasury bonds, which makes these munis much more attractive and shifts the demand curve out. opening up excess demand in the muni market, pushing up prices and driving down the interest rate on munis, right? Where did that demand come from? It came as a migration away from treasury bonds that pay higher tax considerations, which of course eat into your after-tax rate of return. So there's a migration away from the tax sort of, the, the tax applicable status of treasury bonds into the market for munis, which are tax is exempt, right? This pushes down the interest rate on munis and pushes up the interest rate on treasuries, explaining that gap that we saw in our previous diagram. The effect of the Obama tax increase on bond interest rates. In 2013, Congress approved legislation favored by the Obama administration to increase the income tax on high income taxpayers from 35% to 39%. Consistent with the supply and demand analysis that we just looked at, the increase in income tax rates for wealthy people helped to lower the interest rate on municipal bonds relative to the interest rate on treasury bonds as individuals migrated out of the treasury market in order to take advantage of the tax-free status in munis. This has been the first part of our chapter on Chapter 6, and we've broken the lecture up into two sort of pieces, so you can move on anytime you'd like to look at the second installment, which of course you'll find in your course materials. Thank you very much for your time and your attention. I hope this lecture created some value for you, and we'll see you again next time.